Thank you so much, all of you, for joining us on this first Future Spaces of 2025 on market trends in 2024 and a little bit of analysis on outlook on 2025 from three able speakers. The fourth one was unfortunately not able to join us. He's on a different time zone, I think 8 hours behind Kenya, and they had work arrangements, so he's not able to join us. That's David from Moody's. He will be able to join us in future conversations. But we still have very good speakers today. We have Stephanie, we have Harry, and we have Sunil. I'll get started by asking them to introduce themselves, tell us a bit about themselves and how the year started, and then we'll get started on the conversation. So I'll start with Stephanie, and then we'll go to Howie, and then Sunil. Stephanie?
Thank you. Happy New Year. I think it's not too late to say that, but yes, Happy New Year to everyone, and I'm glad to be on these spaces. So my name is Stephanie Kimani. I'm an economist by profession as well as a strategist with over 10 years experience on both fronts, and I'm very passionate about the Kenyan economy, trying to figure out how to improve the economy and just take us forward and to greater heights. So I'm glad to be on these spaces and hope to also gain insights from the rest of the speakers. Thanks.
Howie, over to you.
Hello, everyone. My name's Howie Abonji. I'm a research analyst at Avocap and specializing in macro analysis, both local and global markets.
On that note, you can tell us a bit about Avocap before we get started.
Avocap is a CMA licensed fund manager operating in Kenya. We have a suite of products, both focused on the local bond market, stock market. We also do focus on the African equities as well as global equities. So we have a full coverage of your entire asset universe. And we've been in the industry for a better part of a year, and we're looking forward to welcoming most of you on board.
Thank you. So Neil, it's been a while, so maybe you can reintroduce yourself a bit for those who have not had the pleasure of interacting with you.
Thanks, Eric, and good evening to everyone. My name is Sunil Sanger. Listening to the other speakers, I'm probably much older and more experienced than them. I've been in financial markets for close to 40 years, the last 20 plus years in Kenya, before that in India and in other parts of Africa and the Middle East. I have my own firm called Orion Advisory Services, where we deal mainly with high net worth clients and some institutions. And our focus is on investments. And within that, we largely focus on the fixed income space, which is in treasury bills and treasury bonds. Thanks, and looking forward to interacting with all of you today.
I'll start with the macro side and then come to the equity side and then to the bond side. Stephanie, how was 2024 in the Kenyan macro space, and what are some of your observations of it?
So last year was quite eventful for everyone, and the year was marked by both progress and challenges. So when we start with the progress, I'd like to start with the positives. Inflation did ease quite significantly in the year. We saw price pressures weaken from an average of 7.7% from the previous year, that's 2023, to 4.6% in 2024. And this was as a result of base effects, for those who may know what that means, as well as lower food prices driven by effective government interventions and a strengthening of the shilling, which helped temper down overall imported inflation. Now, when we look at the Kenya shilling, I would say the Kenya shilling staged a surprising and stellar performance against the US dollar. And it was star, even in the sub-Saharan context. We saw the shilling appreciate from 163 to the dollar in mid-January, I believe, to 129 to the dollar by the end of the year. And this recovery was attributed to the timely monetary policy adjustments at the start of the year, as well as just a general fading of those external debt concerns that were there after the early repayment of the June 2024 Eurobond maturity. Now, when we had this easing inflation as price pressures improved and currency stability, we did see the central bank more comfortable in lowering the CBR from 13% to 11.25% presently. And this created a more accommodative policy environment for the market. We did see interest rates overall shift lower, and also borrowing costs cheapened in the year as a number of commercial banks adjusted their base lending rates lower. Now, despite all these macroeconomic gains that I've mentioned, we did see economic activity overall remained quite subdued. And most clearly, there is the Stanbic Bank Kenya PMI, which is generally an indicator of private sector activity, albeit it looks at just a couple of sectors, not the whole private sector in totality. We did see the PMI suggest that private sector activity remained lethargic, and this was as a result of restrained consumer spending and weakened investor confidence, and which limited business investments and activity in that respect. We also saw an increase in public discontent and an uncertain fiscal and tax policy environment, adding on to that drag to economic growth. As a result, it is anticipated that GDP growth in 2024 will likely be around 5%. I believe that the CBK has mentioned around 5.1%, and this is down from 5.6% that was recorded in 2023. Yeah, that's generally the view of 2024. Sentiment-driven challenges, structural challenges, despite several gains on the macro front.
A quick question to you. One of the things that at least the government keeps reiterating to Kenyans is that the economy is doing better, despite some of the things that people feel in the market. Do you agree with the government in the sense of things are getting better, or like more of the common man would care that things are not actually getting better?
There's a phrase that normally says numbers don't lie. So we can only work with the numbers. And I believe that's what the government is doing, working with the numbers. Whether they lie or not doesn't matter. But the numbers do point to an improved macroeconomic space. But there are some challenges that are dragging that lower. Again, like I say, numbers don't lie. There's that phrase. But numbers as well are or can be manipulated. I do not want to assume the latter. I just want to say that the numbers do point to an improved space. Whether we as a people feel it is another question, because even once we have seen price pressures improve, the currency stabilize, incomes have remained quite sticky, the rebound in business activity remains still quite slow, despite easing of those protests that we saw last year. So it's still a struggle. There's still a lag in terms of the recovery. So numbers may point to one thing, but the recovery points to another. And that's what we feel as a people on the ground.
As you heard from Steph, one of the best performing currencies in Africa and worldwide was the Kenya shilling last year. And that boosted a bit of the performance, especially on the equity side. Howie, you can give us a bit of perspective, picking up from there on how the markets performed in 2024, the equity markets especially.
Last year was, you could quite stellar performance for the Kenyan markets. We did see the NSE 25 post its best performance since 2015 or so. It was up around 42.96%. The NASI was up about 34.06%, which was its best performance since 2013. A huge factor behind this performance was, of course, the banking sector, where we saw aggressive growth in EPS. Majorly led by KCB, which posted approximately about 80% growth in earnings, largely due to lower provisions. And I think the regional subsidiaries also showed quite a significant boost in performance. I think the equity markets, we've seen also some of the government-controlled securities or companies also starting to really post some significant performance. We had KPLC posting earnings of about 41 billion for the full year 2024, which actually shocked markets. I think it was the best performing stock last year, up more than 200%. And I think the trend locally, despite this exogenous factors influencing the economy, it's not really translated into pessimistic sentiment within the stock market. And I think the trend for now seems positive. And I think on a case-to-case basis, there's certain sectors that we do see great opportunities in. For Avocap, we've been investing through our Thamani equity fund, mostly focused on banks. Safaricom is something we're looking into. I think they gave us guidance on the Ethiopia break-even. They pushed it back about a year, which has acted to temper the overall performance of the index. But once we see any signs of at least stabilization within that region, then I do think we should continue to see positive momentum towards the upside.
There's some deals that stood out last year. I think one of the ones that stood out was the Bamburi case, which boosted a bit of the performance, especially on that share price itself. Could you give a few pointers on some of the key deals the last year that stood out? I think the other one was KCB was supposed to close a deal to sell NBK, didn't materialize per se. But any other deals that you were paying attention to last year that stood out for you?
Last year, I think, Bamburi was one of the deals that really caught investors' attention. We had Savannah, Clinker, and Amson caught in this, we could say, bidding more, which didn't really materialize in favor of a neutral party. So I think that's one of the major deals we also focused on. Outside of that, it was quite tame in terms of deal making. We are anticipating Kabase to make or finalize a bid for bulk gases. That also is still in no man's land. We are still looking to see if they're going to show interest. And so we do anticipate as rates come down, then we should see more M&A activity. So for now, we're tracking Kabase and trying to see if they might up their bid for bulk gases currently.
I'll come back to you on NPLs once I deal with something very major that happened in the bond market last year. I think the rates were declining for most of last year. Sunil, what's your take on the bond market and how it performed in 2024 in Kenya? And perhaps if you have some perspective also on the Eurobond and all.
Yes, thanks. Now, the bond market was largely influenced by factors that were occurring outside of Kenya. I think Stephanie already spoke about the Eurobond, which was maturing in June 2024. I think this was the first Eurobond issued by Kenya. It was a large one, 2 billion. And there was a bullet maturity or a payment to be made of the entire amount in June. Now, what had happened in the past year or so before that, there had been defaults on international debts by a number of countries, including Sri Lanka, Ghana, Zambia. And Kenya was listed as among the top 10 countries likely to default in 2024. So there was a lot of uncertainty in that, which drove up the yields, which started in 2023. The yields or the rates on treasury bills and on domestic bonds as well as euro bonds going up in the secondary markets. So the Kenya euro bonds actually were in the high teens at 18-19% at one point of time. So at deep discount to the issue price. But of course, the refinancing which happened early in the year of the euro bond and then early repayment, that really calmed things down. It brought the yield back into single digits for the euro bonds. Similarly, if you look at how the treasury bills fared, the 91-day treasury bill started the year at just under 16%, went to a high of 16.73% in March when the doubts or the fears about the default were at the highest on the Eurobond. And then at the end of the year, we're actually down to single digits below 10% at about the yield is about 9.89%. Similarly, the 364-day treasury bill was in December 2023 was at 16.2, went as high as 16.99% in March, and then has declined substantially and closed the year at about 11.4%. So it's a huge swing in the interest rates. More than a 5% decline in the interest rates is massive. Similarly, on the bonds, the most traded and the most active bond in the market was the infrastructure bond, the 8.5-year infrastructure bond, which was issued in February, again at the height of the uncertainty about markets and about the ability of Kenya to repay its debt. And this was issued at a yield of 18.46%. The 8.5-year bond, tax-free bond, issued at a yield of 18.46, which was like an unthinkable yield for issuing a tax-free bond. This has since been appreciating, and now the yields at the end of the year were in the secondary market were somewhere below 14%, in the about 13.8, 13.9%. So that's a huge move in terms of bond yields. Euro bonds have also yields are just under 10% at this point of time. So all in all, we were able to cross the hump of the Eurobond repayment, and certainly things in terms of interest rates look much better towards the end of the year.
For you, given your expertise in markets and having been in markets for 40 plus years, what should investors do in a declining interest rate environment like the one we've observing from last year going into this year? What are the things that maybe investors should pay attention to?
Okay, I think the particularly at this time, during the current year, it was more external factors which determined the movement of interest rates and bond yields in this market. I think one of the major factors was what happened with the US interest rates, the Fed funds rate, which had risen to 5 in a very short time from 2022 to 2023 to 5.5%. We finally started seeing a reversal of that rate during the year, and that was a major relief to bond markets, not just in Kenya, but in most emerging markets. The avoidance of any further defaults during the year in 2024, again, that was a big positive. Number of African countries managed to issue Eurobonds, which sort of the market had been closed in 2023. So I think the first country to issue was Ivory Coast, and then Kenya followed as well. So this was a factor. So I think in terms of investment and looking at interest rates, I think we need to continue to see what's happening in international markets. And there are a few worrying signs, which looks like the US interest rate cycle seems to have now taken a pause. And of course, the uncertainty about the new administration coming in, which is now just less than a week away, and what economic policies they will follow, what impact they will have on the markets. I think we are entering an area of unknown given the new administration that is coming in. So that's something that as bond investors we need to look out. On the local front, we need to see how the government's policies are going to develop. As of now, something that we track is how the government is doing against its borrowing requirement for the year. I think the last stated borrowing requirement that the government stated from the domestic market was 400 billion. This is for the government's financial year, which runs from July to June. The requirement stated was 400 billion, which they have easily surpassed, and currently they are standing at 487 billion. If you can see what the government has been doing, they've been pushing down the rates of treasury bills, refusing to take money at higher rates, rejecting bids. I think in that sense, they are in a comfortable position on their borrowing requirement for the year, unless, of course, we see a big jump in the requirement in the supplementary budget. But I certainly think for the next 6 months, the government seems to be in a fairly comfortable position as far as their borrowing is concerned.
We are joined by Dixon here, who also follows emerging markets and Kenya in particular. Dixon, maybe you can give us a bit of context on Kenya among emerging markets. How is the view from the investor perspective, and what are your observations, especially for 2024?
Hi, everybody, and good evening. For Kenya, the story, like has been told by most of the previous speakers, was a tough start, especially from a yield perspective in the first part of the year, which morphed into a much lower yields down the line. But the story on Kenya actually starts much earlier. I think towards the end of 2023, we did see some bit of investors' interest started to come through on the back of the elevated currency levels. That time was around 158, and yields were already on the way towards 18%. But at that point, at least from the equity side, I think the view was that the high interest rates were going to be disruptive, and we were not seeing any sort of interest there. Mm-hmm. Ideally, it was more of a speculative buy, and the high yields are the attractive bit because the risk-reward metrics were looking slightly better. Currency had moved nearly 25%. Yields are backed up substantially, going towards 18%. At that point in time, we did see quite a lot of interest in Kenya. I think when we issued the first IFB easily, I think the rumored offshore investor participation was about $1 billion. Looking across Africa at that point in time, the other market that was seeing that sort of interest, I think, was Egypt, which was early Feb when they did their deval. And at the same time, they had the 35 billion inflows from offshore side. So those two trades were quite on the fore of our investors. Nigeria also was quite happening at that particular point in time. We had seen the initial deval after the government came in last year, but there was still a bit of hesitation by investors because some of the reforms that they wanted to see from Nigeria had not come through, especially having a fully free-floating currency and having more access to investor participation, especially towards the automobiles, that sort of would have given investors access to yields. Because even if you have yields of 30% like they had gone, but you don't have a pass to buy, then that limits you. Or once you get in, then ability to access markets to get FX at market levels at the point the auction is declared. Then again, those were reforms that were still pending at that point in time. So Kenya was actually quite a good story compared to these other year markets. And for that, I think it was both a currency play for most of the investors who came there, and both a duration play, a currency play, and a carry trade. And for the guys who came in quite early and were unhedged, I think we've seen some guys make returns of upwards of 60% on their trades in Kenya last year, which ideally would have been one of the best trades they would have done in the year. Thanks.
Thank you. Steph, back to you. There's a question here coming through from Derry. He's asking, it's quite evident that the government is having cash flow challenges. What's your general view of the government's creditworthiness going into the new year? And also interest rates decline. Is that reflective really of the government's improving creditworthiness in that regard? Or what do you think?
Oh, wow. I would refrain from stating whether the government is indeed credit worthy or not. Let's answer that question.
Fair enough. Dixon, what do you think about that?
Look, my take, we had this call last year, I think around March, and I think Kenderi was of the view that we might default. I've always said that what we had was a liquidity issue. We are not yet at a solvency issue. Ideally, it's all about how we're budgeting. So we are setting ambitious targets on the budget side, and part of that was supposed to be funded by revenues that were not being met. And obviously, as the yield on the local currency debt started going up, the cost of that then made it likely that we would get into debt distress if the situation did not turn. And at the same time, we had the cliffhanger of the Euro bonds that was supposed to come due in June. Remember, the Euro bond was just part of what was supposed to have settled last year. The total foreign currency maturities and payments last year was 5.2 billion, quite substantial, especially compared with the reserves level we had back then without the support we got from IMF, World Bank, and being able to roll the Eurobond. Ideally, we're looking at close to depleting our reserves if we were to settle that from existing resources. So at that point in time, things were looking dire. As of this time, I think we're in a much better picture, honestly. We've already met the annual borrowing target, so to speak. So I think between now and June, we'll just be rolling over maturities and smoothening the curve unless we see a supplementary budget coming through. So in terms of solvency and liquidity, we are in a much better picture. If anything, I think part of the pushback that we've seen was where we were supposed to draw down some funds from the UAE, and we had to postpone that because we were going to bust the agreed budget deficit ceilings, especially on foreign currency borrowing with IMF. So it's not for lack of market access that we over that hump. So as of this point, I would say maybe the risks are more medium term, more than short term. There is nothing to suggest that our credit worth has become worse. If anything, has become better. If I look back at the Moody's downgrade following the Gen Z's protest and the finance bill being shelved, they were saying we're going to have an issue with market access. We was to a point where, okay, we can't raise revenues anymore because you've suspended the revenue collecting measures and you're having issues getting funding at adequate or at favorable levels from the market because we are issuing at 18%. So the combination of those two meant that things were looking really dire. But that's all changed. So we are now issuing debts at the near end at single digit rates below 10%. We met the annual borrowing program. And ideally, the maturity profile has improved somewhat compared to what we had. I think the next cliffhanger might come around 2027 when you have the next batch of Eurobonds coming through. And my sense is that we are going to be able to roll over this unless there is economy that had very restrictive interest rates. We had inflation at 3% and yields of 16%. We're talking about 12 to 13% real rates. Those are quite restrictive. And we've seen that manifest in the higher NPLs in the banking system, the slowdown in demand and aggregate demand in the economy and household consumption. All these, I think we have a chance that they might ameliorate a little bit. Because if we have lower interest rates, and for arguments purposes, we see a pickup in bank lending, that should help consumption a bit. And if that were to improve, then the revenue side will improve. And if the revenue side will improve, that will be the last cog. We need then to see slightly better ratings, sovereign ratings. Thank you.
Thank you, Dixon. Stephanie, any other observations perhaps on 2024 that stood out for you in terms of the markets, inflation here, there, in terms of the progress the government is making, or at least they were making on the macro front last year?
In terms of other observations, maybe looking at how effective it was, at least the monetary policy and fiscal policy was in managing inflation and overall growth. So when you're looking at it maybe from how effective it was, monetary policy, where we saw it coming from a restrictive policy environment to a more accommodative environment, we did see the success. Inflation was brought down and the shilling was indeed stabilized. So that did help. But what we did not see was how this translates into stimulating the overall economic growth, given that the cost of credit still remains elevated despite some commercial banks lowering the base lending rates. And this is because credit risks still persist in the market. I believe CBK last year in December did state that the NPL ratio is about what? Is it 16%? 16%, 17%? I can't remember nicely, double digits. So credit risks still remain quite elevated, particularly for SMEs, and this still necessitates this higher overall borrowing costs despite the shift towards risk-based lending, which again there's skepticism around its effectiveness and whether it actually works, particularly for SMEs. Now, in terms of fiscal policy and how it supported overall growth, I don't believe last year they had much success owing to various structural inefficiencies, as well as the issues that Dixon has mentioned around challenges in expenditure rationalization and also revenue collection challenges. And Dixon mentioned revenue strategies for the government have tended to be quite overambitious, and combined with the public protest that we did see last year and has died down over the year, and the resultant policy uncertainty, we did see overall private sector activity come lower, and this just dragged down growth. So generally, fiscal policy wasn't as effective. Monetary policy was effective in inflation and the shilling, but in terms of overall growth, that was the gap. And going forward into 2025, this is a hurdle that both the central bank and the government need to work on, having just that coordinated policy response to support growth. I have seen estimations of GDP growth in 2025 being around 5.5% from the 5% I mentioned in 2024, and that's an estimate. So to achieve that growth, there's need for that coordinated response. Obviously, taking into consideration what happens in the global sphere, but locally, that coordinated response will be quite key.
Howie, back to you now. I think the markets have started quite strongly 2025, almost at the same pace at which they closed 2024. Any other pickings that you have in the market in terms of how are investors' moods feeling like heading into this new year?
I think for local investors, I think you're still seeing that FOMO into some of the names that had strong momentum into the end of last year. We still have KPLC being one of the top performers. KQ recently relisted, popping about 60% plus. You've had housing finance as well after the rights issue, performing quite significantly relative to the market. Kenya Re, Britam. So you're almost having this catch-up trade. The laggards are now trying to catch up to some of the higher returning stocks over the past year. Though I think the key factor going to this year will be the geopolitical environment. As we do know, there's a new president in America. His fiscal policies are largely protectionist. And in that, we are likely going to be headed into a period where there's more geopolitical tensions, whether it's with Russia, China. And so a key development we're tracking is also the negotiations between Israel and Hamas. That will be a key contributor towards your export-driven businesses, such as Kakuzi, who use the Red Sea for most of their export activity. And I think shaping into, based on how the geopolitical situation unfolds, and what that does to commodities and what that means for our current account balances and in that the currency, then I think if we don't see a ratcheting up or an escalation in these tensions, then I do believe we're poised to see at least some net foreign inflows into this year. But for now, I think foreigners will still be on hold until there's a bit more certainty or clarity with regards to the global environment.
And then, of course, I think 2 or 3 years ago, there was a time when investors had it rough in terms of taking out money from the country. And there was a backlog with the CBK in terms of investors getting access to dollars and all. I bet the situation has improved a little over that period of time, given like the shilling was at 160 something and now it's 129 and stable over the past half year or so. Has that contributed to investors feeling a bit more comfortable investing in Kenya?
Yeah, the confidence has definitely increased. We're seeing at least some foreigners also coming to our bond market. The stock market, we've seen at least for the past quarter, we did see some net foreign inflows into certain counters. And so I think, the benefit we do have with some of our local securities is the diversification. So at least you have your Bs and equities, which have also large subsidiaries in Congo, which largely have dollar-denominated assets. So it does provide you that currency hedge. And so I think we do have, at least because of the size of our entities, some of these stocks do provide you currency diversification as well as regional diversification. So no singular factor really influences or can negatively impact the stock's performance. So I do think, foreigners might start to open up more because sometimes the commodity price appreciation, if it does occur, should be beneficial for your Tanzania, your Congo. And I do think some of our local counters should stand to benefit from these factors or events.
All right, Sunil, what are clients telling you about their worries heading into 2025 in the Kenyan market?
What we have seen largely from our high net worth clients is caution that I think what happened, particularly with the exchange rate in the leading up to probably around February 2024, when the shilling in a very short time went from about 120 to 160. I think that has shaken the confidence of a lot of high net worth investors. So to a certain extent, we are seeing that investors, when they are getting bond maturities, they're not reinvesting, and only a part of it is getting reinvested into new issues or into new treasury bonds. So we have seen a lot of preference of moving into hard currency from our clients. Because this thing, they don't want to go, that this cycle is very much recent and in recent memory for investors. And they certainly don't want to see that kind of loss in hard currency terms of their investments. So there is caution in those terms that we are seeing from investors. The interest rates, of course, at the beginning of the year, 18% tax-free were very attractive. When now rates are at the 13 to 14%, there is a little bit of reluctance to commit for long term at this time from our investors.
That reflected a bit in the T-bills, right? People want to lend short term, 90 days, and stay away from the 180, 365 one. Is that something also that would push rates a little lower or a little higher? What would be a trend if investors keep insisting on only lending at short-term rates only and not wanting to lend longer term?
Yeah, so to that extent, yes, the shorter term rates would continue to trend lower, and the central bank has been doing a good job of really rejecting higher rate bids and making sure that the treasury bill rates come lower. But that, I think, at least on the 364 days, we are not seeing that happening really in a significant way now. The kind of drops that we were seeing in the November and December are no longer happening. So we are probably getting close to equilibrium in rates, and we may not see the short-term rates going down very much more. A lot of our investors are waiting to see if there's a new infrastructure bond issue, which in general, an infrastructure bond issue always gets a good response from the market, both from domestic investors as well as from foreign investors. In terms of the interest rate gap with international rates, I think that has closed. It's not as attractive as it was in the middle or at the beginning of 2024 or even in the middle of 2024. I think with now uncertainty on US rates, we have already seen the bond yields in the US starting to go up. The US 10-year bond now is yielding at 4.79. So when we compare that with about 13% or just under 14% in Kenya, that yield is starting to look less attractive to foreign investors, the gap that is there, particularly if the Federal Reserve now slows down or stops reducing interest rates. Again, some of you who follow international markets may have seen that the UK bond yields have gone to a high that is a multi-year high, the highest level since 2008. I think the yield gap or the carry trade, which a lot of foreign funds do, is not as attractive as it was during 2024. So we may see a slowdown of foreign investments into Kenyan bonds and treasury bills. Whereas I think short-term rates will stay low or could even trend lower. I do not see that much room now for decline in the bond yields during 2025.
We are almost towards the end of the spaces today. So if you have any questions that you want our panelists to answer, I'm going to go one round of questions and then we're going to take a few questions from the public. So I'll start with Stephanie. In terms of outlook for 2025, what are some of the key things that you yourself are paying attention to? And some of the things that you expect at least to happen in the markets in 2025. Also, one more question for you is, does the government have space for more taxes and the option of the financing last year and the fact that they need to raise government resources?
Okay, let me first start with the outlook 2025. Now, into 2025, I would say that economic conditions are in a colicky state. That is that the economic environment offers both promise and uncertainty. We've seen the stabilization of the shilling in 2024, and the current administration did very well. The government, central bank, whatever you want to call it, did very well in stabilizing the USD cash rate. And we are likely to see not as much pressure as we did see in 2023, but nonetheless, there are some external factors that are likely to feed into the cash value in this year. One, Sunil did point out the interest rate differential narrowing, so local currency assets may not be as attractive to foreign investors. So that could weaken that attraction on cash. And secondly, less attraction to local currency assets and thus less demand for cash. So that could result in pressure for the Kenya shilling. I anticipate at the end of the year, maybe we could see the Kenya shilling move from the current levels about 128, 129 to about 143, 145. So yes, some pressure, but not as much as we did see in 2023. Now, when we're looking at inflation, we could see local inflation still remain within the target band. That's a statutory target band of between 2.5% and 7.5%. No significant pressure is expected, but that said, we have seen some climate change factors feed into not only just Kenya, but even globally. So those weather-related disruptions, geopolitical tensions, as has been mentioned by Howie, that could disrupt supply chains, as well as transport of various goods, manufactured goods, into Kenya via the Red Sea. And this could trigger some pressure, especially on food prices. And I anticipate that the central bank will be quite keen and alive to these risks. And as a result, I don't anticipate the central bank will ease monetary policy as much into this year as they take into consideration what happens with the US Fed. Sunil has also mentioned what's going on with bond yields in the UK. So the central bank will be less keen on aggressively cutting rates as they take note of what's happening in the global sphere. Now, in terms of whether all this will have positive knock-on effects to the private sector, it's yet to be seen. I anticipate that, yes, borrowing costs will be lower. There has been calls for the commercial banks to lower their lending rates, but I don't anticipate this will be fast enough. Again, like I mentioned earlier, there has been some skepticism around risk-based lending. I will be on the lookout to see whether that comes through quite strongly into this year and also result in an increase or enhanced growth in private sector credit, which is currently in single digits, around 4% year on year as at October last year. That's what I'll be looking out for this year. Thanks.
And on the shilling, though, what gives you confidence the CBK would allow it to get to 140 from the 129 it's been on for the past couple of months?
At this point, you can only do so much in managing what's happening in the local front. You cannot escape the realities of what's going on in the global front. So I anticipate that even for the central bank and the government as well, to instill confidence for investors that, yes, the market is responsive, the market or the shilling is responding to market moves. I believe they will allow with some leeway, if possible, to weaken to that level if need be, just for that confidence. We can't control what is going on outside. We need to also instill that confidence for investors, especially foreign investors, that the market is responding to various events and it creates some sort of predictability that, yes, our market is functioning. So if there's some confidence there that they will allow it, if need be, to get to that level of 143, 145 by the end of the year.
And CBK next month, they're having an MPC meeting. What would be your suspicion on what they would do?
From 11.25, maybe hold for now as they take a look at what's going on in the market. Just a hold.
All right. Dixon, over to you. Perspectives on 2025. What are you watching?
I think it's more of the same, really. For now, what is really key is to see how the revenue performance picks up from here. We know that in terms of funding the government, most of the heavy lifting and the H1 was covered through debt issuance. H2 is quite key usually on covering the revenue side because the performance is never evenly distributed. It's always weighted more to the H2. So we've seen good performance from banks and generally, I think from some of the corporates and SOEs who've done well last year, I think there could be a pickup on revenues there. We want to see whether the interest rates coming down might help some of the consumption side, maybe try and boost some import demand. And also, as we see the savings coming through from the lower cost of debt issuance, whether we see a bit more public spending. We know that the development expenditure side of the budget has been quite limited. With the interest rates coming down, I think every 1% drop in interest rates, I saw someone modeling saying it brings between 100 to 200 billion in interest costs savings. So those savings, as they start manifesting, as we roll over the debt using cheaper interest rates, and then could be applied towards development expenditure. That could see some bit of capital goods imports picking up, and generally that then boost revenue slightly. What's key, I think, we'll have to watch out is the weather. We've been very lucky. I think we've had 3 seasons now where we had good rains. That has anchored inflation and it really helped the growth number, at least the headline number, to remain robust. Without that catch-up performance over the last 2 years, I think would have been in a much different scenario. And the fact that we are at 4%, despite agriculture being well-performing, then tells you that we've really fallen back on some bit of good weather luck. We hope that sustains into this year, which will help anchor inflation. We've seen a pickup in energy prices globally over the last few weeks. I think Brent, I see today, went above $80 per barrel. So obviously it tells you that there'll be some pickup in inflation over the next few months, especially energy pass-through. We had a huge boost from the base effects coming from when the currency was 160, which will start fading off in Feb when we had a huge currency correction, which then means we would see inflation edging back towards 4%. I've seen a few forecasts taking it back to around that level. And if we don't see any pickup in food prices, if rains are okay, then that should be the level that we would see going forward. The current account deficit, I think, is expected to also slightly pick up again over the same issues that I've raised. My sense is that banks and the economy will have to extend credit to the private sector, because if there's no incremental borrowing from the government between now and June, the coupon payment pipeline, if you look at the domestic cost of debt that was budgeted, and most of that was coming H2, was about 800 billion on the Kenyan shilling side. So all those coupon payments will be coming to the system between now and June. So investors are going to have a huge investment risk of that amount of liquidity. And in the absence of any outlet, I feel that we'll have to extend to the private sector, at least in the next few months. Lack of good borrowers obviously could slow that down, but it's always a chicken and egg story. Sometimes you have bad borrowers because interests are too high and there's no demand for credit, or the ones you loan to then can't find anything profitable that they could do to pay the extra higher interest rates. If rates were to come down, maybe both of those could sort themselves out. You could have more people interested in borrowing, and you could also have less defaults, and PL's side at least starting to improve. Growth, I think, again, might be depend on agriculture again. We had some drag from the protests last year. So hopefully, if we don't see a lot of those, maybe we could get back towards the 5.3% that's been touted, or 5 to 5.5%. It's still not as stellar as the medium-term plans were, but definitely better than the 4% we saw for Q3. Other than that, I think the global picture, we have to see what pans out of, especially the new administration in the US. There's been a bit of parallels been mentioned with 2017, where market came into other inauguration with a very strong dollar, but the intricacies of negotiating and passing stuff through Congress then means that things might not happen as fast as you imagine. And the very strong bull case for dollar might not actually manifest as people expect. There might be that the efficiency move to other government in the US then leads to actually lower government spending, and some of the inflationary impulse that market is anticipating doesn't come through. So if that were to happen, and if it manifests as 2017, then we could actually see dollar getting softer into H2. But for now, I think the market is anticipating quite a strong dollar into Q1 and into H1. That by itself might be a drag towards emerging market investment. So maybe on the offshore investor side, you might not see as much as we would have seen last year. Also, with the prospect of duration gains, like Sunil has put, having diminished, then there is less incentive to come and buy our bonds. However, I still feel that the equity side remains cheap, both even historical. And I think we could see a bit more flows into that. Could be naked or hedged. Either way, I think there could be some value, especially given the still decent dividend yields that we are seeing there, and the low price to book values.
Over to you, Howie, and then Sunil on outlook for 2025. And especially for you, Howie, perhaps you can tell us some of the counters that you're closely watching as you head into this new year, or at least some of your clients are.
As Sunil mentioned, we do have a bull steepener where the short end is rates are falling faster than the long end. Empirically, this tends to favor the banking sector. So I think factoring in the strong capital positions, as well as you could say hesitancy to lend or extend their loan book, I do believe they'll be paying out most of the excess cash as dividends. And so we might see payout ratios increase, which in turn would result in higher dividend yields at current prices. So today, the counters I'm mostly looking at would be your KCB, your equity, and your DTB, which tend to have relatively lower payout ratios as opposed to the other lenders. So I think aside from that, we're also looking at Kakuzi, aside from giving you that currency hedge, because most of the income is dollar denominated. We do believe Israel's negotiations with Hamas that are meant to conclude over the next few days could result in the reopening of the Red Sea, which I think should be beneficial for the exports to Europe, which is their largest market. Aside from that, we also like KPLC. Technically, fundamentally, we are seeing quite an improvement in their performance. I think as a proxy to KPLC, we are looking at Kengen. I think the improvement in their working capital position should be beneficial to Kengen because most of their receivables from KPLC. So I think in that Kengen could also possibly or potentially be paying out larger dividends over time. I think we're well positioned and looking out for opportunities as they come. I think we currently have a well-diversified portfolio. We are holding, at any given time, we're holding more than 10 different securities and constantly trading them using both technicals and fundamentals to decide when to enter and exit. I think another risk to be aware of is, as Dixon mentioned, the weather has been favorable. And I think currently there's projections that East Africa might be faced with drought conditions for the first quarter. Couple that with increasing sanctions on Russia's oil. I don't know if that will result in them restricting their fertilizer exports, which again should result in higher fertilizer prices, which essentially would mean lower crop productivity across most economies. I think the inflationary factors or pressures are currently more pronounced. And I think that could be something we're really tracking and to be aware of.
I'm surprised you didn't mention AI, given it's a market driver. AI at all?
Oh, we do have AI investments. So we like to express our views not directly into AI. So our global equity fund does have some holdings that are exposed to AI. We do have some companies that do help with providing the industrial pipes that are required for the water-cooled systems. We do have some companies that do provide the backup power systems for most of your data centers in our book. We also do hold some of your chips. I think right now chip production, or you could say productivity, is shifting from US-centric more towards Asia. And so we do have some names in Asia we're tracking who stand to benefit from this increased protectionism around AI technology, as well as increased productivity or production within their local regions. So I think we are well invested in the AI theme, and we do have our global equity fund that primarily invests across systematic portfolios, and we have our multi-asset strategy that's now more short-term oriented based off the macro environment.
One curious point, though, how do you express your market views usually? Do you use derivatives, or do you directly invest?
So more often than not, we're directly investing. Derivatives, maybe if we see some asymmetric opportunities or risk return opportunities is when we might use some derivatives or as a hedging tool. For instance, right now, we had started looking at some energy positions. So to hedge that exposure to our energy stocks like ExxonMobil, your Shell, your British Petroleum, we might consider buying some hedges to protect the downside. So you might short your oil futures, or we might buy puts on the XLE, the energy ETF. So we do have various mechanisms of expressing our views, but it's mostly equities. Derivatives on any day, less than about 2% of the entire portfolio.
So Neil, market views for 2025?
For 2025, particularly on the interest rate front, I'm not overly optimistic on the outlook. In fact, I'm more cautious. One of the data that came through, I think, late last week was that GDP growth in 2024 for third quarter had fallen to 4%. This was against 6% at the same time last year. Now, this is the lowest quarterly growth since first quarter of 2021, which I think we'll all recollect. That's quite a slowdown in the economy. Yes, definitely the high interest rate environment would have contributed to that. But I think it's also a question of business confidence. Are businesses reinvest? Are people investing in business? I see less and less of that at the moment. I think there's a perception that this government is not really friendly to business. I don't know whether the government can reverse that perception in the current year. Otherwise, we will continue to see GDP rates not quite achieving the targets or the expectations which have been put out by central bank. Tax revenues also, I think the scope for growth in tax revenues and government revenues is now limited. I think there's a lot that has been squeezed out from the economy, and the room to squeeze it further is limited. So really, increase in tax revenue has to come from basically growth in the pie, and that is not happening. That is slowing down. So it's a difficult situation. And the other issue with the tax revenues not increasing at the same pace, does the government have the intention? Does it have the will to rein in expenditure? That is the other big question. As we saw that when the budget was rejected in June, there were a number of expenditure items that were to be dropped, and there was a lot of things which the government said that they would cut back on. But all of those seem to be slowly making their way back in. Again, that I think we need to observe what the government is going to do this year. And really, that is what will show us the way forward, whether the economy is recovering or whether we are going to be limping along for the rest of the year. So sorry to be on a sort of pessimistic note, but I think really it's now up to the government to set at least the tone for a revival of the economy and for us to again see faster GDP growth and not be stuck at this under 5% growth. That's my outlook for the year.
Before you give me your closing thoughts, there's a question here, one from Derry and one from Justin. Justin is asking, does the panel expect Kenya to access international markets this year for liability management, whether Eurobond or the other Panda bonds and all? And from there, he's asking, what do the panelists think of the drop in tax collections in November when compared to the previous year, November 2024, compared to 2023? And what do you think about Kenya's unemployment rates, trends in banking and NPLs, and the competitiveness of Kenyan companies? They're open questions, so you can tackle them from whichever angle you want. But there's one here which is specific, I think, for Dixon, which I think is more of a no. As any part of the USD 1.5 billion that was expected from UAE come in, that's one you can answer directly, and then the panelists can answer the rest of the other questions. Dixon?
Oh, that has not come through. I think there was a bit of discussion surrounding that number. I think they were trying to plug that in as a last bit after the last review from the IMF, I think, and the World Bank. I think the balancing number was supposed to be that. Media reports we've seen that they split that into this fiscal year and into the next fiscal year. Ideally, the balance of what they do this year and what they do last year, I guess, and next year is that maybe that's what they're trying to see and come to that conclusion. On the revenue side, I think generally, look, this year, especially Q3, given the outcomes we've seen from the economic side, is from dairy. I think it's understandable why we've seen the sort of flatlining revenues. We did not have any impact from the inflation side, inflation being the lows at 2% year on year by December. Usually just on an inflation basis, if inflation was close to 10%, you'd have seen that pick up in nominal spending, which then translates to slightly higher taxes. Inflation was quite low. And you've seen the growth numbers coming through. And if you sift through that and once you strip out agriculture, then there wasn't that much growth. So the numbers in November, seems understandable. And especially if you consider the fact that the public sector spending also still remain constrained, with the government really rushing to plug the gaps on delayed payments, delayed disbursements that was seen in the first few months of the fiscal year. Looking forward, I think the jury is out. We have the taxes that were instituted with the new finance bill. They call them appropriations and spending bills that were just signed, as opposed to what would have been signed in June and July. Maybe that will give some sort of a push. How will that number look? I am not really sure. I think we have to wait for the next estimate on the supplementary budget that will come through for us to have a picture. But I do expect there will be some small pickup into this half compared to the first half, simply because we do have slightly higher taxes. Basically, we have more taxes that have come into stream. And I think the sort of which we had last half of the year has reduced a little. I can pass on the other question to the rest of the panelists.
Anyone wants to tackle some of the other questions that were raised?
In terms of international markets, whether we would return to the international markets, I don't see Eurobond being issued the current year in 2025. I think it's going to be more multilateral or bilateral kind of borrowing that the government would do. So again, like this UAE was one example, which is the bilateral debt, plus of course the support from IMF and World Bank. I think that's the kind of foreign borrowing that we would see. I do not expect a market issue like the Eurobond during the current year. In terms of tax collections, I think Dixon did address that. And I think I also spoke about it earlier that we seem to be reaching the maximum capacity that can be drawn from the current business environment in terms of taxation. And really, unless the GDP grows, the room to grow taxation much more is going to be limited.
I agree too. Any other thoughts?
Yeah, just to mention, I think NPLs, the trend, we do expect the trend to at least start to decelerate over time. I think it's a case that the government might prioritize pending bill payments going to an election period. And so I think that will be their transmission mechanism or their fiscal support program into next year. So I think we might see some recovery in those NPLs going forward.
You are more optimistic, but there's also the lag between the reduction in rates and actually when they land in the interest payments of the business and the consumer. Don't you think that's a bit of a worry though? Because I think towards the end of last year, there was a bit of pressure from CBK to banks to lower rates, but then reduction of 100 basis points may not be that significant to someone paying 25% rates of interests to banks. Any thought there, Howard?
Yeah, that's true. Again, I think that's one of the risks to be quite aware of. I think there's an invisible hand currently within the space. So it might not necessarily be positive to their bottom line, all in all. But I think in terms of just their balance sheet strength or the solvency status, I think at least we could see some NPLs get recovered, especially those linked to the government. So your KCB, your equities, your large corporate lending entities.
Time for closing thoughts. I'll start the same way I started with Steph, and then Harry, Sunil, and then Dixon. Steph, any closing thoughts? Something they should talk about that you may have with?
A lot has been said, actually, and Dixon has added quite a bit of value to the conversation. Now, for my thoughts into 2025, it's a mix. And like I said, we're in a colicky state, holds promise, but we need to be very cautious. And a lot, I believe, of how 2025 will perform will be on how the government is able to manage sentiments towards its own fiscal policy as well as on the general political landscape. So I believe that would be ideal for the government to focus on how they manage those sentiments moving forward, because it's going to ultimately determine how businesses will reinvest and invest moving forward and thus support overall growth conditions. And also various uncertainties, both globally and locally. Now, when you look at the global sphere, how the central bank tries to align its policies to what we're seeing globally, where US policy rates, for example, may not decline as fast as we anticipated before. Given other indications, also the current regime, the Trump administration may not be as favorable or welcoming to certain developing economies like ourselves. So we need to look at other sources or access to other financing abroad and ease off that pressure locally. There's a lot that we need to look out for. But for me, specifically, is on how the government is able to manage sentiments and investor confidence moving forward. Because the key driver of this economy is the private sector. Whether it's foreign or local, it is the private sector. They contribute 70% to GDP. So it will be important for them to be able to manage those sentiments and confidence moving forward. Thanks.
Howie, then Sunil.
In light of the pessimistic tone across the board, I think when it comes to equity positioning, I think this could be the year where utilities do provide you a favorable risk return, both due to the recurring or predictable stream of revenues, as well as at least the improved management. We do still see banks, at least some banks, performing going forward. And in the global markets, we do see a flurry of opportunities. We still see opportunities within the banking space. I do think some of these geopolitical tensions should be beneficial for some of your commodity-driven economies, such as your Congo and Tanzania's. And so we do see some of our banks with exposure towards those regions benefiting from that increased activity. Again, even your protectionist policies should drive more bilateral trade agreement between these commodity producing nations and your developed economies. So outside of that, on global markets, we want to remain quite agile, and we're still looking at some of the ways to express this AI themes and sectors that stand to benefit. I know we started with the picks and shovels, but now we are moving more towards your software beneficiaries. And we do have our AvoCap funds, which are professionally managed. We have our active management strategies using both fundamentals and technicals to help us take positions. And I think we're going into a time where there's going to be increased volatility. So it will be beneficial for most investors to consider professional active management for their portfolios. So I do think this is a time to be active, more active when it comes to portfolio management.
Thanks, Howie. Sunil, maybe you can give us your closing thoughts now.
I think I was a little bit negative or a bit pessimistic in look. Let me try and end on a little bit of a positive note. So firstly, on the exchange rate, I think the central bank did very well in 2024. I think they ditched some of the disastrous policies that had been followed 22, 23, which while so-called the exchange rate was not depreciating, but we basically were down to rationing of the foreign exchange to $5,000 and $10,000 a day. So I think the CBK did very well in removing those kind of controls that were artificially imposed on the market. And I hope that they will continue with letting the market really determine the exchange rate largely. And if they do want to have a guidance on the exchange rate, then they do it as a market participant, either by buying dollars or by selling dollars. And I agree with, I think Stephanie's thought that the rate would go to roughly around the 140 level during the year. And hopefully that will be orderly if it is allowed to go by normal market participation. The other positive aspect I thought I'll highlight in terms of the bills and bonds. I think sometime in 2023, in the second half of 2023, the central bank introduced something called the Dow CSD system. And those who have been investing in bonds and treasury bills would by now be familiar with the system. So I think this was a big improvement from what old system, the CDS system, which the central bank had, which required a lot of manual intervention, required personal visits to central bank to open the account and a lot of manual work. I think we are seeing the benefits of it in terms of more and more individual investors investing directly in treasury bills and treasury bonds. I think from 2022, when there was about the non-institutional investors holding about 6.4% of the issued securities, this has gone up to over 13% as at the end of 2024. So I think that's a very good move that the CBK did. It's a very good system. And I mean, those of you who have invested through the CDS system, through the Dow system, should definitely try it. It's very easy to open the account, easy to operate. And of course, there are people around to give you guidance if you need in participating in that. So I think that is one thing that will, again, tend to moderate any rate increases that we see. If we see those during the second half of the year, will be direct investor participation in the treasury bills and treasury bonds. I think I'll leave that as my closing thoughts.
Thank you, Sunil. Thank you, Howie, and Stephanie, and also to Dixon, who also managed to join us towards the end. Thank you for those perspectives. I hope investors are well informed. We'll continue to have more Twitter spaces as the year progresses. There's something that Sunil mentioned, the Dow CSD, a very good one to use to invest in government bonds. I have tried it and it's actually very, very simple in terms of the way to invest. And of course, Howie is around here from Avocap to help us throughout the Q1 to be able to analyze some of the content that we come across in markets and all. So Sunil and Howie, I want to give you a chance to tell people where to find you before I close. Sunil, first, perhaps, where do people find if they want more information?
Well, I guess since we are doing this on Twitter, on X as it's now called, the best thing is drop me a message or a DM on Twitter and then we connect. We have our offices in Westlands in the address. And of course, once we've connected, we would be happy to meet up in person as well to discuss further. Yeah, thanks.
Howie, where can people find you?
Thank you, Howie. I'm a research analyst at Avocap. You can also send us a DM. We have our website. We have our app. You can download it on the Play Store. And we look forward to welcoming you to our suite of funds. We think we do have the widest range of products in the market. And I think this is a year of really capturing opportunities or at least avoiding risk. So we welcome you to join us.
Thank you all. Let's call it an evening.